If the news cycle lately feels like you're strapped onto a rocket ship, pointed straight at the future, but the launch pad itself is being run by this like constantly squabbling bureaucracy, well, then you probably get the core conflict we're seeing right now. Yeah, our sources today, they really paint an incredible picture of this tension. We've looked through reports detailing just staggering corporate earnings, all driven by AI, and then boom, minutes later, you see the whole market crash because of geopolitical tariff threats. And all this is happening while essential government services are kind of crumbling under political gridlock. It's
Gets it.
something. So our mission today is pretty simple. We want to connect these two seemingly opposite forces. How does this high-flying AI market, this explosive growth, how does that impact your long-term portfolio? And at the same time, how does this government instability affect your immediate reality? Whether that's thinking about retirement security or just like navigating a flight delay. Okay, let's unpack this. Starting with the biggest force shaping markets right now, that huge demand for AI infrastructure.
Right. It's really not just a tech story anymore, is it? It's
Yes.
fundamentally a massive capital investment story. We're literally watching the physical construction of the future.
Mm-hmm.
And that's why these picks and shovels companies are just booming. The whole focus is sort of shifted. It's less who makes the best software and much more who can build the biggest, fastest data center.
And the numbers, I mean, they back that up dramatically. Just look at Applied Digital, a data center builder. They closed Friday up 16%, okay? But get this, it's up a stunning 344% year to date. It's incredible.
Yeah.
And this wasn't just like random speculation, it was driven by real numbers. Q1 revenue hit $64.2 million. That crushed the $50 million estimate, and it's an 84% jump year over year.
But you got to look at the scale of their commitment, because that's where the real money story is. They expanded their lease agreement with CoreWeave, and that brings the anticipated contracted lease revenue for just one campus, Polaris Forge 1, up to $11 billion.
$11 billion for
Well,
one campus.
$11 billion. So that's $64 million quarterly revenue. It's just a tiny fraction of the long-term guaranteed revenue streams they're locking in now.
Wow. And Applied Digital, they're building capacity for 600 megawatts across 2 sites in North Dakota alone. Their CEO wasn't wrong when he called them the modern-day picks and shovels of the intelligence era.
Well,
And here's the really crucial data point, I think. Hyperscalers are expected to spend $350 billion in AI deployment this year. Just this year.
exactly.
That really tells you the kind of foundational investment needed to support this whole revolution.
What's fascinating here is
Yeah.
we see investment expanding way beyond just chips and data centers now. It's going all the way to robotics and even this grander vision of artificial superintelligence, or ASI. Take SoftBank, for example. Their stock jumped over 11%. Why? They agreed to buy ABD's robotics unit for $5.4 billion. And the goal is to advance what they're calling physical AI.
Physical AI. Okay, so that implies AI that can actually interact with the real world, not just, a chat bot. But is this real? Or is it SoftBank's founder, Masayoshi Son, just kind of talking up his book? I mean, he says he envisions ASI being 10,000 times smarter than humans. That sounds a bit like science fiction, maybe designed to pump the stock.
Well, it's probably a bit of both, right? The capital commitment is definitely real. $5.4 billion is a serious move into hardware.
Yeah.
But the ambition, yeah, it reflects the narrative you need to build, this belief that the next AI generation needs control over real-world machines. But, regardless of the marketing spin, the supply chain is definitely responding. Look at Korean chipmakers. SK Hynix up over 8%, Samsung up 6%, both hitting record highs. And that's driven by these massive deals like the one involving OpenAI and AMD. NVIDIA's up too, partly because their CEO confirmed funding Elon Musk's XAI.
But this kind of high-stakes growth, it inherently creates massive friction, doesn't it? Like on the creative side, OpenAI's Sora 2 video generator, it hit 1 million downloads in just 5 days, which is astonishing speed. But Hollywood agencies are already slamming it as exploitation. Big concerns about copyright, intellectual property.
Oh, it's a total mess.
Oh, yeah.
Regulation is just scrambling to catch up. And we saw the, frankly, absurd consequences of this when some testing prompts failed. Like, apparently trying to generate a video of a fat orange cartoon cat eating lasagna didn't work because of these new copyright filters they put in.
Seriously, a cartoon cat.
Yeah. The systems are really struggling to figure out, fair use versus infringement in real time. It's complex stuff.
And if that domestic IP issue is complex, the geopolitical side is, well, it's a full-blown international investigation now. The U.S. Commerce Department, working with Singapore police, they're probing Megaspeed. That's an NVIDIA customer. And the allegation is they helped Chinese companies get around U.S. chip export curbs.
Right, and this is a huge, really nuanced story. Megaspeed reportedly bought almost $2 billion worth of advanced NVIDIA gear. But instead of just using it in Southeast Asia, the claim is they set up data centers there that were actually remotely serving customers in China.
So, like a digital backdoor.
Kind of. It's not just about smuggling chips anymore. It's about operating this digital bypass system, actively trying to undermine U.S. tech controls, and enforcing these export rules in a globally connected data center market. It's proving incredibly difficult.
Okay, so that deep dive into AI and all its global friction, it leads us right to the other half of our thesis today, instability. If AI is laying the groundwork for, what, $350 billion in growth, why did the entire market just collapse on Friday?
Yeah, it collapsed because, well, high growth just can't be sustained without political stability. And that stability pretty much vanished with one major threat. The Dow fell 878 points. The S&P 500 dropped 2.71%. That's its largest single-day decline since April. And the Nasdaq plummeted 3.56%. The trigger was purely geopolitical risk.
And that risk came from former President Trump's threat, right? A massive increase of tariffs on Chinese products. He was accusing China of holding the world captive over rare earth metals, which are, essential for everything electronic these days.
And here's where it gets really illuminating for investors, I think. You saw this immediate, really stark split in the market. Companies with significant China exposure, think Alibaba, Baidu, they slid about 8%. Even the Magnificent Seven stocks, like NVIDIA and Tesla, they dropped too. The market was instantly pricing in a potential trade war.
Right. But then you look at the flip side. Stocks involved in rare earth production, they surged. MP Materials was up 15%, USA Rare Earth up 19%. It's like a direct quantifiable stress test, isn't it?
Figured it.
Shows the market is already valuing asset security and supply chain independence, maybe even over growth potential right now. When fear spikes, capital rotates into tangible stuff.
Absolutely. And that anxiety was measured directly by the VIX, Wall Street's fear gauge. It spiked above 22. We haven't seen levels like that since June. That tells you investors are panicking about risk spreading beyond just tariffs and trade wars.
Yeah, because globally, investors are already dealing with political gridlock that's actively hurting economies right now. Like the U.S. government shutdown, it's now in its 10th day. The Senate failed, for the 7th time to pass funding measures?
And the consequences are immediate and deeply personal for some people. We saw the announcement that federal worker layoffs, they call them RIFs, reduction in force notices, have actually begun. So they're officially laying off non-essential employees in departments like HHS, Treasury, and the unions are already vowing lawsuits.
Even crucial economic data is getting messed up. The CPI report, the Consumer Price Index for September, it was delayed. Now they're saying staff are being brought back to work on it for an October 24 release, but that delay, it's critically important for millions of people.
Exactly. The Social Security Administration relies on that CPI data. They needed to calculate the annual cost of living adjustments, the CLAs, before November 1st. If that data isn't ready on time, it genuinely risks delaying those CLA adjustments for millions of retirees. This is political dysfunction directly hitting personal finance planning. It's not abstract.
And if you happen to be traveling, the disruption is real there, too. Airlines for America warned travelers, basically, expect potential flight delays, cancellations. Why? Because of air traffic controller shortages in key airports like Burbank, Nashville. Essential staff are working without pay. And, fatigue, staffing shortfalls.
Yeah.
It inevitably leads to slowdowns.
And this problem of gridlock, it's definitely not just a U.S. thing. It's global. Look across the pond. France's political crisis, it cost their economy an estimated 0.2 percentage points of GDP, purely due to the uncertainty. President Macron had to reappoint Sébastien Lecornu as prime minister amidst all that chaos. And Lecornu's immediate job, deliver a 2026 budget that tackles a forecast deficit of 5.4% of GDP. That's nearly double the EU cap. So political instability isn't just, headlines. It's a measurable economic drag everywhere.
Okay, so if the world is experiencing this, explosive future-building growth on one hand and crippling political decay on the other, where are investors putting their money? This really brings us to the rise of the debasement trade.
Yeah, the debasement trade is it's a fundamental bet, basically. It's the belief that because global governments and, let's be honest, specifically the U.S., are engaged in just massive borrowing and have these serious fiscal concerns. Ray Dalio even warned it echoes the pre-World War II debt surge.
That's a heavy comparison.
It is. The bet is that the value of the U.S. dollar will inevitably erode over time because of all this.
And when sovereign debt and currency values start looking shaky, capital shifts into hard assets, and we're seeing it. Gold is up over 50% year to date. Silver is up over 60%. Even Bitcoin is climbing, near 30% up, recently hitting over $120,000. This isn't just retail investors anymore. It feels like institutional trust is shifting.
Oh, absolutely. And we have a massive institutional data point that confirms this. Global central banks.
Hmm.
They now own more gold than U.S. Treasuries for the first time in nearly 30 years.
30 years.
30 years. That tells you the biggest, most cautious players on the planet are actively hedging against the stability of sovereign debt.
It's a huge signal.
So in an environment defined by this kind of volatility, how do we even think about investing? The advice from, seasoned voices like Jim Cramer surprisingly still kind of holds true, but maybe you need some context now. He always stresses buying best-of-breed stocks quality is key and practicing patience, even if a stock is, quote, temporarily broken.
Yeah.
When the market crashes like it did Friday, the high-quality assets are probably the ones most likely to recover first. That's true. But the crucial counterpoint, especially in this kind of accelerated environment, is flexibility. You have to be flexible. Kramer also urged investors, and this is key, be willing to acknowledge when your core reason for owning a company fundamentally changes. Maybe there are new competitors, maybe unforeseen events. You just can't be emotionally attached. If the story is really broken, you need to be willing to, as he puts it, sell the darn stock.
Right. Okay, shifting gears a bit to personal finance planning. This instability means you absolutely must be hyper-aware of regulatory changes, especially around retirement savings. You really need to know about this upcoming 401k rule change. It comes from the Secure 2.0 Act.
Yes, this is a major change, particularly for higher earners. Listen up if this is you. Starting in 2026, okay?
Yeah, right.
If you're a worker age 50 or older and you earn more than $145,000 a previous year, your 401k catch-up contributions generally must be made as after-tax Roth contributions.
Okay, why did Congress make this change? What's the thinking there?
Well, it's widely seen as a way to sort of plug an expected tax loophole, basically to increase future tax revenue for the government. But for you, the high earner, it means you lose that upfront tax deduction on those catch-up contributions.
So you pay tax now, not later.
Exactly. You're paying tax on that income immediately rather than deferring it. So it really requires some immediate planning, maybe shifting tax strategies over the next couple of years before it kicks in.
Got it.
Now, on a more positive note, perhaps, for many families dealing with high costs, the IRS did announce some inflation adjustments for 2026. We're going to see higher maximum amounts for the Earned Income Tax Credit, the EITC. That's a pretty major boost for low and moderate income workers. For example, the maximum EITC will go up to $8,231 for qualifying taxpayers who have 3 or more children.
And the adoption credit maximum is also going up, right? To $17,670. So, okay, we see some assistance growing on one side, while retirement planning for higher earners gets, well, more complex on the other.
Yeah, the core theme just keeps coming back, doesn't it? We're navigating this acceleration of opposites. We're simultaneously witnessing these record investments, building the future, like, $11 billion data center deals for AI, $5.4 billion flowing into physical robotics, and this ASI dream. Yet, at the very same time, the present feels like it's destabilizing rapidly, driven by trade wars, fear gauges spiking, government paralysis.
So what does this all mean for you, listening right now? The world is simultaneously building this incredible future and destabilizing the present we live in. Maybe ponder this. Does the sheer accelerating pace of technological innovation, shown by these record AI investments, does that create a force strong enough to actually offset the economic drag? The drag caused by, increasing global political fragmentation and these domestic shutdowns we're seeing. You really have to consider how these opposing forces, this rapid tech evolution versus this kind of governmental decay, how they'll shape your own personal financial planning, maybe even your career decisions over the next 5 years. Will your sector be totally transformed by that $350 billion flowing into AI? Or could it be crushed by the rising VIX and increasing tariffs? We'll leave you with that thought to chew on. Thanks for diving deep with us today.